Welcome back to the deep dive. Today we're looking at something that I think for a lot of people is just a formality, a document you have to get through.
A hurdle. Yeah.
Exactly, a hurdle to clear before you get to the exciting stuff like revenue or market share. We're talking about the balance sheet.
Or the statement of financial position, right?
And I want to set the stage here because usually people treat this like a static checklist. Does the company have cash? Check. Is the debt okay? Check.
And that's such a mistake. Because if you treat it as just a checklist, you completely miss the narrative.
What's the narrative?
I mean, think of it this way. The income statement is like a video. It shows performance over time. But the balance sheet is a high-resolution freeze frame. It's a single snapshot.
It's a snapshot in time.
A single moment. And if you know how to read it, it tells you everything about a company's liquidity, its solvency, and I think most importantly, its flexibility.
That's the key word, isn't it? Flexibility, the ability to pivot.
So for our deep dive today, we're working from a pretty technical analysis on external financial reporting, covering U.S. GAAP, IFRS.
The whole FASB framework, yeah.
But the goal here isn't to get bogged down in debits and credits. It's to figure out what these rules are actually signaling to investors and creditors.
Because it's all about risk assessment. It's about capacity. You're looking at what a company controls its assets, and then who has a claim on those things, the liabilities and the equity.
Sounds simple enough.
It sounds simple, but all the nuances in how we define those terms and really when we decide to recognize them.
Okay, so let's start there with the rule books. The source draws a really sharp line between the two big ones, the U.S. GAAP and IFRS.
Right.
And for anyone with a global portfolio, this is a huge deal. GAAP is always described as rules-based. What does that actually mean in practice? It means it's the strict regulator. U.S. GAAP is incredibly prescriptive. The U.S. has such a litigious environment, so the standards are written to give you an exact answer for a specific scenario.
So if you're in software, there's a rule for that. Real estate, there's a rule for that.
Precisely. It's designed to minimize ambiguity, to give you a clear box to check.
Okay, so then we have IFRS, the international standard, which is called principles-based. And the criticism I always hear is that this is just code for make it up as you go along.
Ha, that is the cynical take. And, there's a kernel of truth there. IFRS does rely more on the judgment of management and auditors to show the economic substance of a deal.
Rather than just following the letter of the law.
Exactly.
Yeah.
But the interesting thing the source points out is that this can actually force a more honest conversation. You can't just say, well, I followed the rule. You have to ask, does this actually represent reality?
So despite this philosophical difference, rules versus principles, the end result is often pretty similar.
For the most part, yeah. A loan is a loan, cash is cash. They've been working to converge the standards for years, so while the path might be different, the destination is usually more alike than different.
Okay, let's move on to the framework itself. The big equation. Assets equals liabilities plus equity. We all learned that. But I want to talk about this idea of articulation.
Oh yeah, this is so important. The idea that the statements are not islands. They're an ecosystem.
An ecosystem.
You can't touch one without, vibrating the whole spider web.
Yeah.
The classic example is net income. You earn a profit on the income statement.
And it flows directly into retained earnings on the balance sheet.
Exactly.
Yeah.
Which means the quality of your balance sheet is only as good as the quality of your earnings.
Ah, so if a company is getting really aggressive with how it recognizes revenue,
it's going to show up. You'll see it as bloated accounts receivable on the balance sheet.
that's a great example. If you see income going up, but cash from operations isn't, and receivables are just skyrocketing.
The balance sheet is telling you the story. It's telling you the quality of that income is, frankly, pretty low. They've booked the sales, but they haven't gotten the cash in the door.
The articulation shows you if the story holds up.
It's the ultimate fact checker.
But before an item even gets on the sheet, it has to meet these recognition criteria. The source lists 4. Definition, measurability, relevance, and reliability. I feel like measurability is the big one.
It's the biggest hurdle, especially now. I mean, to record an asset, you have to be able to put a number on it with some certainty.
In the industrial age, that was easy. A factory cost $10 million to build. Done.
Exactly.
Right.
Boom, measurable.
Mm.
But now, in the information age, how do you measure the value of a brand? Or a user base? Or a brilliant algorithm?
You generally don't, which we'll get to. But this measurability rule is why the balance sheet can feel so disconnected from, say, a tech company's stock price.
It creates a massive gap. A huge gap between what accountants call book value and what investors call market value.
Okay, let's unpack the assets side. What we have. The technical definition is rights to economic benefits from past transactions. And we split them into current and non-current.
Right.
Now, current is usually defined as 1 year, but the source adds this little wrinkle, 1 year, or the operating cycle, whichever is longer. Why that distinction?
It's all about matching the accounting to the actual business. The operating cycle is the time it takes to spend cash on materials, make something, sell it, and get cash back.
So for a grocery store, that's what? A few ranks?
Maybe, but for a winemaker or a company building a
We're
skyscraper,
aircraft carrier.
exactly. That could be years. So if you're analyzing a defense contractor, their current inventory might be tied up for 3 or 4 years.
And that's critical for a liquidity analysis. You can't treat the hull of an aircraft carrier like it's cash you can use to pay the electric bill next month.
Not unless things have gone very, very wrong.
That brings us to specific assets. Let's dig into inventory. It's usually raw materials, work in process, and finished goods. Most people just look at the total number.
But the mix tells you so much more. The mix is the diagnostic tool.
How so?
Well, if you see finished goods inventory spiking while sales are flat, that's a huge red flag.
It means you're making stuff you can't sell.
You're making stuff you can't sell, and you're probably going to have to write it down or have a big sale later on.
What about if raw materials are spiking?
That's more ambiguous. It could be a strategic move. Maybe management is stockpiling because they see a supply chain crunch coming.
Or they're getting ready for a huge surge in orders.
Right. So rising inventory isn't automatically bad. It really depends on which bucket is filling up.
Context is everything. Okay, let's talk about a newer term. Contract assets. This came out of the new Revenue Recognition Standard, ASC 606. It sounds a lot like accounts receivable.
It sounds like it, but it has a very different risk profile.
Okay.
An account receivable is an unconditional right to payment. The work is done, the invoice is out, you're just waiting for the 30-day payment term to end.
You're just waiting for the check.
Exactly. A contract asset means you've done some work, but you still have another hoop to jump through before you can even bill for it.
Like hitting a performance milestone.
Perfect example. You're a consultant, you've done 50% of the project, but the contract says you can't bill until the whole thing is successfully implemented. That value you've created, that sits on the balance sheet as a contract asset.
So from an investor's perspective, a contract asset is way riskier than a receivable.
Much riskier, because if that project fails at the 90% mark, you might never get to bill for that work. The asset just evaporates.
Oh, wow. That's a huge distinction.
Yeah.
Okay, let's shift to the big stuff. PP&E, property, plant, and equipment. But I want to contrast that with intangible assets because the source points out this huge distortion, this make versus buy problem.
This is one of the biggest debates in accounting. It's fascinating.
Lay it out for us.
Okay. If you buy an intangible asset, let's say you acquire another company specifically for its patent, you record that patent on your balance sheet at what you paid for it. It's an asset.
Simple enough.
But if you spend the exact same amount of money developing that same patent internally, paying your own scientists, running labs, the accounting rules generally say you have to expense those costs as you incur them.
Wait, so Company A buys a patent for $10 million and gets a $10 million asset on its books.
Right.
And Company B spends $10 million inventing the same thing, and they have 0 assets to show for it and $10 million less in profit that year.
That's the reality. And it makes comparing companies incredibly difficult. An innovative company that grows through its own R&D will look asset poor and less profitable than a company that just acquires all its innovation.
It basically penalizes organic innovation on the financial statements.
It does. It can make the organic innovator look weaker in the short term, even if they're building far more sustainable long-term value.
Let's flip over to liabilities, what we owe. We have the usual suspects, like accounts payable, but I want to talk about this refinancing loophole the source gets into.
It's not quite a loophole, but it's a very specific exception.
Okay, an exception.
Normally, any debt that's due within 1 year is a current liability. It hits your working capital, makes you look a little more fragile.
But the source says you can reclassify it as long-term if you have the intent and ability to refinance it.
That's it. And ability is the key word there. It's not enough to just say, oh, we're planning to refinance. You have to prove it. Usually, that means having a signed agreement from a bank in place before the balance sheet date.
So for the listener, why does this matter?
Because it can make a company look safer than it is. If you see a lot of debt suddenly shift from current to long-term, you have to remember that that ability to refinance could disappear.
Like in a credit crunch.
Exactly. Like in 2008, if the bank pulls that commitment or the company violates a covenant, all that debt snaps right back to being due now. And suddenly a company can look insolvent overnight.
There's also a quick mention of agency collections, things like sales tax you collect from customers.
Right, this is a cash flow illusion. A company collects sales tax, that cash sits in their bank account for a bit, but it's not their money. It's a liability they owe to the government.
And some struggling companies might use that float.
They'll use that float to fund operations for a few weeks. It's a dangerous game. It's like using the government as your personal high-interest lender.
Let's get to equity, the residual, assets minus liabilities. It's often just seen as what's left over, but the components tell a huge story. Specifically, let me talk about retained earnings.
Retained earnings is basically the company's fuel tank. It's the sum of every dollar of profit the company has ever made minus any dividends it's paid out.
So a company with huge growing retained earnings is self-funding its growth.
They don't need to go to the bank or issue new stock. They're a machine that generates its own capital.
And on the flip side, if that number is going down or it's negative.
That's an accumulated deficit.
Yeah.
Means the company, over its entire life, has lost more money than it's made, or it's paying out dividends it can't afford.
Then there's treasury stock. This is when a company buys back its own shares. The source calls it a contra-equity account, which means it reduces total equity.
It does. Now, the big question is why management does this. The positive spin is they believe their stock is undervalued. It's the best investment they can make.
And that less positive spin.
It's a way to pump up earnings per share. Your EPS is just earnings divided by the number of shares. If you shrink the denominator, the number of shares, your EPS goes up, even if your actual profit is completely flat.
It's financial engineering.
It can be. So when you see a company buying back billions in stock, you have to ask, is this a confident bet on the future? Or is management just out of good ideas for how to grow the actual business?
That's a great question. So, okay, we built the whole structure. Assets, liabilities, equity. But let's close on the limitations section, because the source is very clear. The balance sheet does not tell you what a company is worth.
Not at all. And it's not designed to. It's a historical record, not a crystal ball.
And the biggest reason for that is the historical cost principle.
Oh, absolutely. Think about it. A company bought a piece of land in Manhattan in 1970 for, say, $1 million.
Okay.
It still sits on the balance sheet at $1 million. But today, that land might be worth $100 million. The balance sheet is totally blind to that increase in value.
Which completely distorts your return metrics, right? If you calculate return on assets and your assets are based on 1970 prices.
Your ROA looks incredible. You look like a genius because your denominator is tiny. A competitor who buys the building next door today for $100 million will look way less efficient on paper.
Then there are the estimates. We talk about measurability, but so many of these numbers are just management's best guess.
Things like warranty reserves or the allowance for bad debts, how many customers are going to default, it's an estimate. And if management wants to smooth out their earnings for a quarter,
they can just be a little more optimistic with their estimates.
It's judgment, and judgment is always subjective.
And finally, the biggest blind spot of all, the missing assets. We talked about internally developed R&D, but what about the people?
Human capital. I mean, the value of a firm like Google or Goldman Sachs walks out the door every single evening. But you can't own people, so they can't be assets. You can't put a number on company culture or brand loyalty.
And that seems to be the central problem of modern accounting. As we shift to this intangible economy, the balance sheet is capturing less and less of what actually drives value.
It is. It forces you as an investor to look beyond the financials. You have to look at employee turnover, customer churn, things the accountants can't measure. The balance sheet gives you the skeleton, but it doesn't show you the brain or the muscle.
So if it's this flawed, if it's biased toward the past and missing the most important assets, why do we still say it's the first place you should look?
Because it's the only real check on reality we have. The income statement can be massaged, cash flow can be volatile, but the balance sheet has to balance. It's an equation.
The books have to close.
You have to close. If you're burning through cash, it shows up there. If you're piling on debt, it shows up there. It might not tell you the company's full value, but it is brilliant at revealing its risks.
It's the skepticism filter.
It is the bedrock. You can't build an investment thesis without it.
So a final thought for our listeners. Next time you open up a company's report, don't just look at the totals. Look at the mix of that inventory. Look at the nature of the debt. Ask where the equity is coming from.
And always, always ask,
Mhm.
What is truly valuable about this business that the accountants are not allowed to put on the page? Because that's where you find the real insight.
A perfect place to leave it. We've turned what looks like a static spreadsheet into a pretty dynamic map of a company's choices and its risks. Thanks for diving in with us.
My pleasure.